I'm Charlotte McLeod with the Investing News Network, and here today with me is Ronald-Peter Stoeferle, Managing Partner at Incrementum and author of the In Gold We Trust report. Thank you so much for joining me online today once again. Great to see you again.
Hi, Charlotte. Good to see you.
Yes, really good to see you, and we have a lot to talk about today. We're not actually too far yet into 2022, so I wanted to take a quick look back at gold in 2021 and get your thoughts on the performance that we saw there. I know there was some disappointment. I wanted to ask you, do you think that people just expect too much of gold? What are your thoughts on gold last year?
Well, of course, it has been some sort of a disappointment, and we actually wrote a piece called "Why Gold Lost Its Mojo," where we basically try to find some reasons why gold did disappoint, and I think there's a couple of reasons. First of all, we saw an enormous strength of the US dollar. The Dixie index was up 7%. Second thing was we saw huge opportunity costs. The S&P 500 I think was up 28%, made 16 new all-time highs. Without any major volatility. So actually, the need for a portfolio hedge wasn't really there. And then I think that crypto also kind of stole the show from gold, definitely. And I think we should not forget the performance of gold in 2019 and 2020 especially was spectacular. So gold was up 18% in 2019. It was up 25% in 2020. And last year, in US dollar terms, it was down 3%. So from my point of view, it was taking a breather. Obviously, now everybody is scared of the rate hike cycle that is just getting started. We crunch the numbers, and actually, it's very much of a sell the rumor, buy the fact. So the time after the first rate hike should be very supportive for the price of gold. And at the moment, I think the technical picture is really constructive. So I'm pretty excited about the outlook for gold.
Yeah, so let's talk about gold in 2022 now that we have a picture of what happened last year. You mentioned what's going on with the rate hikes from the Federal Reserve. I think that's definitely top of mind for people right now. And I've heard a lot of different varying views on what that's actually going to look like. So could you tell me what you think we're going to see in terms of rate hikes in 2022?
Well, I think that we're now really seeing some sort of a peak hawkishness. You know, if you have a look at the forecast from major Wall Street banks, they they really try to compete who's making the boldest forecast, and who's forecasting the most rate hikes, and I just don't see 7 rate hikes happening. I don't see 9 rate hikes happening. I'm on record saying this will be the shortest and the shallowest rate hike cycle in the history of the Federal Reserve. We wrote a book called The Zero Interest Trap in 2019, so before COVID, and we said basically that the next cycle will be weaker than the previous cycle, and I think the case for that, due to the enormous surge in debt, is stronger than ever. So I mean, that's a fairly simple economic concept that still many people don't seem to get. The higher the debt, the bigger the sensitivity to rising rates, and therefore I would bet strongly against 7 or 9 rate hikes, whatever. And I think actually, we had a very interesting call with an Indian investor this morning, talking about Fed policy, and I would love to be a mouse sitting in the conference rooms of the Federal Reserve and the ECB, just listening to what's going on there, because there's just no good way out. I think the markets markets are really getting nervous, not only the equity markets, but also the bond market. And you can see it in credit markets now as well. Just have a look at credit default swaps, have a look at junk yields. So so I think the market is already demanding the U-turn of the Federal Reserve before they even got started. Uh, and on the other hand, we are seeing, midterm elections in the United States. We're seeing that the popularity of Joe Biden is not really high. We're seeing that inflation is becoming more and more of a concern for people and for businesses. So there's no easy way out, but from my point of view, they will, as they usually did, they will rather surprise on the dovish side. So perhaps there will be 2 or 3 rate hikes this year, but I think that's gonna be it.
Right. And you started to mention inflation. What are your thoughts on inflation in 2022? Because we know that, as you said, is a big concern for many people.
Well, I think that COVID was really the tipping point when it comes to inflation. I think that the great moderation is basically over. 4 decades of very low and even falling inflation rates. So most people, most asset managers, most business owners really don't know how to navigate in an inflationary environment, because we just didn't have it for the last four decades. Now, now I think what people tend to forget is that fiscal policy is becoming more important than monetary policy. Therefore, I think we should talk more about fiscal stimulus than monetary stimulus going forward. I think people tend to forget that this wage price spiral is just getting started. People underestimate the strength of the bull market in energy. I mean, this is only obviously the geopolitical premium is now coming on top of that, but I'm very concerned having a look at spare capacity. So I think that over the next couple of weeks, I think we will see some sort of correction in oil, but I see oil prices going to 110, perhaps even higher this year. So so that's basically a stagflationary environment, because the yield curve is already telling us, well, the Fed is making a policy error, the economy is weakening. We are seeing the Atlanta GDP indicator for the first quarter has weakened dramatically. Um, so actually, I think the recession clouds are getting darker and darker. Um, and this is gonna be the tightrope that central bankers are walking on. It's very slippery, because on the one hand they will have to fight inflation, on the other hand they will try to support asset markets. Just to give you one number, Charlotte, um, the US household ownership of equities at the moment is at 43 trillion. So that's basically twice the US GDP, which means that this inverse wealth effect, as soon as equities start falling, we will have a consequence for consumer sentiment. We will have a negative impact on spending. So this household ownership of equities is at new all-time highs, and therefore I expect that the strike of the Fed put will be significantly higher than in previous cycles. So I think at one point the market will realize, well, actually the emperor has no clothes, because the most powerful tool of a central banker, is working with lowering and hiking rates. this tool basically is not in the toolbox anymore. So you have to invent new tools. I think at some point there will be a yield curve control. I think at some point the Federal Reserve will start buying equities, and of course CBDCs will be the next big thing. Um, in addition to more and more fiscal stimulus. But we can already see from this kind of dire forecast that I'm having, that market forces will not be allowed to work, and that, as a free markets guy, that makes me quite concerned.
Okay, and interestingly, I think you're the second person within the last week or so who's brought up the fiscal side of things and mentioning that we need to be looking at that too, in addition to the monetary side. So I wondered if you could talk a little bit more about what you're looking for there and why this is something now that may be coming up a little bit more often.
Well, I think that politicians during the COVID crisis, they basically realized, well, we can come out with really, really big fiscal stimulus packages, and it works. So we are seeing an impact on economic growth. We are seeing an impact on inflation. We are seeing an impact on employment numbers. So I think they felt like kind of being the saviors of markets. They rescued us, and therefore I think that, as soon as those recession clouds are becoming darker, and this is happening, I think the solution will of course be, I don't know, a new Green Deal, a new infrastructure deal, a new education deal, whatever. Of course, they will come up with great names and good marketing terms for those packages, but it will be basically fiscal stimulus. And I think, this is happening. This is happening not only in the US, but very strongly in the Eurozone. This is happening also in China now. We tend to forget that commodities were up 27% last year, even though we saw a strengthening US dollar, and we saw, sorry, a fairly hawkish Chinese fiscal and monetary policy. Now, I think the Chinese are opening up again. They are becoming more aggressive again. I think that should have an impact on commodity prices. I think that should have an impact um, on Asian markets. So therefore I think this is kind of a paradigm change, yeah, and it's happening slowly, but you know market commentators basically over the last couple of years, they primarily try um to forecast what central banks would do next, and I think this is slowly changing now. So let's focus more on politicians and focus less on what central bankers are telling us, because as I've said, their toolbox is almost empty.
Okay, so we've been talking about some factors that have been there for a long time for gold. They should have a long-term impact. I want to also bring up some current events because it's quite relevant right now. We have what's going on with Russia and Ukraine. This is a quickly developing situation, but I hope we could touch on it a little bit and get your thoughts on what's going on in terms of gold, whether it could be a longer-term factor as well, or if this is something that is going to be a shorter-term impact.
Well, obviously the situation in Ukraine is scary. I mean, I'm not too far away from the Ukrainian border, although it's not where the whole turmoil is happening, and in the eastern part of Ukraine. But I think it escalated quite quickly, and most people saying that, well, Putin is only, he's kind of a rational player, and he's uh, it won't be that bad after the Monday speech that was extremely aggressive. Many people that I really love reading and listening to that really have deep insights into geopolitics and especially Russian politics. They were really concerned, and they think that the market is not really seeing a complete escalation of events. And you know, I don't know. Before the First World War, nobody said, "Well, let's start a world war." It just happened, and those tensions were building up for years, if not decades. Similarly to the tensions that we're seeing now, and of course, we are wanted to have some sort of a happy end, but I just don't see it. So therefore, I think it will have a long-lasting impact on markets. When it comes to gold, I think that people completely overestimate the geopolitical premium. I think this panic reaction, well, there's a terrorist attack, there's whatever war starting, let's buy gold. I think that's it didn't work out too well historically. It has a short-term impact on the price of gold, but I think that and we wrote 15 in Gold We Trust reports over the last years. I think gold works as a hedge against turmoil in equity markets. Gold works as as an investment in an environment of negative real rates. It works as a dollar hedge, and I think it works as some sort of a, let's say, a recession hedge, and gold already discounts a future recession very early on. And I think this, we are seeing negative real rates, we are seeing kind of wobbly and increasingly nervous equity markets. We are seeing that the recession might be on the horizon. So I think this uh, the price of gold basically confirms that going forward there will be some events happening that should positively impact gold. Um, but I would not advise to buy gold just because of geopolitical events.
Okay, that makes a lot of sense. Thank you for that. I want to hopefully tie everything that we've been talking about together and ask you what you see for the gold price in 2022. Do you have a specific prediction that you're looking for, and what might it be?
Well, I think that the next stage of this bull market is just getting started. I see new all-time highs this year, and let's face it, we're $170 away from the all-time high. We can go to new all-time highs basically in 1 or 2 weeks, and then there's no resistance anymore. And I think then we could easily go to 2,300 US dollars. I think, Charlotte, what's really important is I think 4 weeks ago when we saw on a Friday enormous volatility and almost panic in US equity markets, we saw the largest inflows into the gold ETF, the GLD, the largest inflows in history. So this is telling me that many institutional players are reconsidering gold. I think that many asset allocation committees are now becoming more cautious. They say, well, inflation is stickier than expected. Equity markets will be quite bumpy this year. Um, so therefore, I think that gold really has reappeared on the radar screens, and I expect um, a pretty good performance this year. And we're already seeing when it comes to the major mining stocks, we're already seeing quite a decent performance. We're seeing pristine balance sheets. We're seeing high free cash flow generation. We're seeing companies buying back stocks. So that's actually a really good environment for gold and also for gold miners. Perhaps I'm talking my book, but I'm pretty confident.
Okay, and so we have gold with this momentum behind it. Do we see silver go along for the ride in 2022?
I think if gold goes where I'm where I'm thinking it will go, I have a hard time believing that silver will underperform. And I think at some point people will rediscover silver. But I think it's I don't see I don't see silver decoupling from gold as many silver bucks would see it. So I think silver really needs support from the price of gold. But if we go to new all-time highs, I can easily see silver at $30 or even higher, because obviously it also has a very attractive supply demand setup. Therefore, if my call on gold is correct, you should definitely reconsider having some silver.
Okay, and just a quick note on the company side, you're mentioning the gold companies, the gold miners. Is that where you're seeing the most opportunity among the companies that are actually mining right now, or what about at the other levels as well?
I think if you go down the value chain, I see tremendous value in the development stage. I think there is some great explorers with really fantastic projects that will be taken out over the next couple of months. Um, but it's as usually now we're seeing more flows into the large caps. And I think if this bull market grows and matures, people will feel comfortable taking more risks. So they will go to the mid tiers, they will go to the juniors, they will go into the silver space and so on. But I think this process is just getting started now.
Okay, well, now as we wrap up, I just wanted to ask if you have anything else on your mind that you would want investors to know about, and perhaps you can let us know about the upcoming release of the In Gold We Trust report, because we know you're working really hard on that as we speak.
Well, you know, we're a team of more than 20 people, and we're almost working 24/7 on the upcoming In Gold We Trust report. Will be published on the 24th of May. Um, for the first time, we will publish it not only in German and in English, but also in Spanish. So that's a very important innovation for us. And I think I think going forward, it might make sense in this year to reduce beta, to take some risk, to take some chips off the table, to de-risk your portfolio, especially in the tech space. I'm not too confident going forward. And perhaps it's time to reconsider gold and mining stocks. I think we crunch the numbers on basically answering the question what works in inflationary times, and it's commodities and gold. Uh, Gold had two great years, 2019, 2020, 2021. It took a breather. Commodities had a tremendous year in 2021, and I think this is really continuing. So if we are right that we are in a new inflationary paradigm, and it doesn't necessarily mean hyperinflation, but sticky inflation between 3 to 6% over the next couple of years, which is obviously also kind of a solution to the debt situation that we're in, then I think commodities and gold should do fairly well.
Okay, well, I think we'll wrap it up there. That's a great point. We can focus all we want on gold, but there's all the rest of the commodities out there too. So thank you so much for coming on to share your thoughts.
Thank you very much, Charlotte. All the best.
And to you as well. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Ronnie Stoeferle of Incrementum and the In Gold We Trust report.